Welcome to This Explainer. Today, we are tackling a massive challenge that companies face every single day. We're talking about choosing exactly which projects to invest their hard-earned funds in without losing their shirts. Imagine you've got a cool 10 lakh rupees ready to invest in a brand new piece of machinery for your business. How do you confidently evaluate if that project is actually a sound financial decision? I mean, it's not a guessing game, and the stakes are incredibly high. To solve this, we're going to open up our financial toolkit and examine a couple of non-discounting methods. Today's agenda covers making capital decisions, the payback period, its merits and demerits, the accounting rate of return, its pros and cons, and finally, the non-discounting flaw. Let's dive right in. Starting with Section 1, Making Capital Decisions. Here, we're looking at capital budgeting exclusively through the lens of speed. And that brings us to our very first technique, the payback period, or PBP for short. Think of this as your project's break-even point. It answers one burning question: exactly how fast are you going to get your original investment back? In the business world, liquidity is often king, so knowing exactly when a project pays for itself provides a fantastic baseline for any major decision. Calculating this metric is actually super straightforward, and it depends entirely on the nature of your returns. First, you just identify if your cash inflows are the same every single year or if they fluctuate. If they're constant, it's a simple division. Divide your original investment by the annual cash inflow. Easy, right? But what if they're unequal? Well, then you just track the cumulative cash flows year by year until they match your initial investment. Let's see how this builds in a real-world, unequal scenario, with an initial investment of 10 lakh rupees. If we track the cumulative cash year over year, in year 1, we bring in 2 lakhs. By year 2, we add another lakh, bringing us to 3 lakhs. Year 3 gives us 4 more, so we're at 7 lakhs. We just keep adding these up to see exactly when we cross that 10 lakh finish line. Tracking that cumulative total, boom, we hit the 10 lakh mark exactly at the end of year 4. That makes our payback period precisely 4 years. It's a highly tangible, easy-to-grasp metric that any manager can instantly understand. Moving on to Section 3, Payback Merits and Demerits. PBP is wildly popular across the corporate world, but it's far from perfect. The core friction of the payback method is basically a double-edged sword. On one hand, it's an absolute lifesaver for companies dealing with a cash crunch because it heavily emphasizes quick cash recovery. But its fatal flaw? It completely ignores any and all profits you make after that payback line is crossed. A project could literally generate millions in year 5, and the payback period method just wouldn't account for it. Beyond just speed, PPB naturally mitigates risk and brilliantly relies on actual hard cash flows rather than somewhat subjective accounting profits. But dangerously, it completely ignores the total useful life of the asset, and it utterly excludes the time value of money, which is a massive caveat we'll discuss shortly. So it's a great tool for a quick read, but certainly not the whole story. Because payback totally ignores overall profitability, we need a different lens. That brings us to Section 4, Accounting Rate of Return. Unlike PBP, the accounting rate of return, or ARR, is essentially the accountant's perspective. It focuses strictly on accounting profit, not raw cash flows, to give you an annualized percentage return on your investment. It essentially answers the question, over the entire life of this project, what is my average annual return going to look like on the balance sheet? To compute ARR, we break the formula down into these steps. First, figure out your average annual profit after tax over the project's entire useful life. Pay special attention to the second step. To find the average investment, we generally just take half of the initial investment while also factoring in things like salvage value and any extra working capital. Finally, you just divide that average profit by the average investment and multiply by 100 to get your final percentage. Let's actually put this into practice. Imagine a new machine costing 25 lakh rupees. It has zero salvage value, meaning at the end of its life, it's practically worthless. However, it yields an average annual profit after tax of 3,30,000 rupees. Our average investment, using that half roll we just talked about, is 12,50,000 rupees. By plugging those exact numbers into our formula, dividing 3,30,000 by 12,50,000, we reveal a really solid accounting rate of return of 26.4%. And this perfectly illustrates how management actually uses ARR. They take this 26.4% and simply compare it against the predetermined acceptable rate. If their minimum hurdle is, say, 15%, this machine definitely gets a green light. Which leads us directly into Section 5, ARR, Merits, and Demerits. ARR gives us a fantastic snapshot of profitability, but it comes with some pretty significant limitations. The crucial trade-off here is all about balance. While ARR brilliantly considers the entire lifetime of the project, which solves the exact problem the payback period had, it relies heavily on accounting profits. That's a serious demerit because accounting profit can easily be skewed by subjective corporate policies, like exactly how a company chooses to calculate depreciation or value their inventory. It's just not cold, hard cash flowing into your hands. Furthermore, while ARR uses really conveniently available ledger records, it has some bizarre quirks. It frustratingly treats all timelines and investment sizes equally. Think about it. A project lasting 3 years and one lasting 10 years could literally have the exact same ARR, making them look identical on paper when they clearly aren't. And, just like the payback method, it completely ignores the time value of money. This massive shared weakness brings us to our final segment. Section 6, the non-discounting flaw. Both PBP and ARR are what we call non-discounting methods. That simply means they completely ignore the exact timing of when the cash actually hits your bank account, which leaves us with a critical, provocative question to ponder. If 100 rupees today is fundamentally worth more than 100 rupees tomorrow, thanks to inflation and potential earning power, are these two tools alone truly enough to confidently risk your company's millions? Or is there a more advanced toolkit waiting to be explored? Keep that in mind the next time you evaluate a project's projected returns. Thanks for joining me on this explainer, and keep asking the right questions.